Give an introduction. Yeah. So, good morning, everyone. I'll first give a little bit of introduction about myself. So, I started my consulting career with Arthur Andersen, and then I moved to PwC. I was PwC for 21 years, and last 3 years I've been again back to Andersen. Earlier it was known as Arthur Andersen, now it's known as Andersen Global. So, the Indian CA is a CA from Nangia Andersen, is a part of Global Andersen Global. I have worked largely in the space of financial service sector, mainly uh, helping MNCs or foreign investors or Indian financial service sector players in setting up their businesses, structures, getting their regulatory licenses like SEBI licenses, RBI licenses, and onshore structures, offshore structures, GIFT City, IFSC, and so on. So this session is mainly on comparison between AIF, PMS, mutual fund, and direct investing directly in the stock market. So most of us, I think, invest in stock markets. We are all, or we may be advising our clients, or we may be participating in one of the intermediaries in the entire ecosystem. So some of us may be from the broking side, managers, like fund managing side, or custodians, and so on. What you will notice is that not many pay attention to the finer details of the differences between the investment through these routes. So therefore, I thought it'd be good to take everybody through what the finer aspects are, because you will also see that if you are dealing with any of your relationship manager from any wealth management company, you will find that not all the wealth managers or relationship managers are familiar with each and every aspect. So some of the aspects are so important that that should make a key difference for an investor to decide whether he should invest through which route. So, so to begin with, just an overview of uh, the two main the two main pooling vehicles, so to say, because mutual fund is something that many of us are familiar with. So I thought first I'll begin with a comparison between AIF and PMS, and then we'll add the mutual fund aspect as well. So as you all know that in AIF is like a mutual fund, it's a separate vehicle, and therefore the investment decisions are made by the investment manager. Similarly, in PMS also is a pooling vehicle. So some of these aspects most of you may be familiar with, but I'll highlight those which are lesser known aspects in some of these. So an AIF is a fund, PMS is not a fund as such. It's just that there are multiple ways where the PMS manager decides to invest for you. So investor hands over the money, and the PMS gives you an option that either the portfolio manager has a discretion to decide what to buy, and that's called discretionary investment scheme. Whereas non-discretionary, where the portfolio manager identifies stocks, but he still calls up investor and confirms that is this what you want to invest in, and so on. And the third angle in the PMS is the advisory, where he only advises and the execution or the actual investment buying decision is taken by the investor himself. Similarly, the second is the segregation of funds. In case of AIF, it's a common pool of funds, so the money goes into the common AIF bank account. Whereas in case of PMS, there is a separate demat account for each investor, so that each investor is in the position to identify his or her own portfolio. Pooling of funds, as I said, is yes, and in PMS, no, because it has to be identifiable money. Similarly, in terms of investing into investee company, uh, AIF category 1 and 2 does not invest more than 25% of corpus in one single company. And similarly, in AIF3, not more than 10% of the corpus in one single company, because AIF3 is largely for listed stocks. So therefore, the investee concentration is 10%, whereas there is no such restriction for PMS. Similarly, tenure AIF category 1 and 2 can be close-ended, minimum is 3 years, and as a market practice, the maximum tenure is 7 years. And category 3, which invests in largely listed security, there's no tenure, therefore it can be open-ended. Whereas in PMS, there's nothing like a tenure. You put in 50 lakhs today, you can withdraw it next week. And then lock-in is there as per the contractual agreement between the investor in case of AIF. In AIF, it is if it is close-ended, then investor has to adhere to the lock-in period. Normally, it is 1 year, and in case of PMS, you can withdraw anytime subject to the lock-in period and subject to the load. So that load is something similar to what we have seen in mutual funds as well. So exit charges is in case of AIF is contractually agreed, whereas in PMS generally, as per the market practice, like this, that within 1 year is 3%, then 2 years and 1 year and 1%, and generally there's no exit load after you withdraw if you withdraw after 3 years. Minimum net worth for the manager, there is no requirement for AIF, whereas for PMS it has to be 5 crores. And minimum investment by the investor is 1 crore for AIF and PMS is 50 lakhs. And corpus minimum corpus of the fund itself is since there are there have to be 20 investors and each investor invests 1 crore, so therefore the minimum corpus is 20 crores. Whereas in case of PMS, there is no limit. The PMS manager can start with as low as 50 lakh. You don't have the requirement of having minimum number of investors. Even if you have just one investor, the PMS manager can simply start with 50 lakhs. And the manager has to remain invested in case of CAT 1 and 2 AIF to the extent of 2.5% or 5 crores, whichever is lower. And in case of CAT 3, it is 5% or 10 crores, whichever is lower. So this is basically the skin in the game that the manager also is invested and therefore there is no conflict. The conflicts are resolved. Whereas in case of PMS, the PMS manager himself is not required to keep invested in because there is no pool of funds. Each investor has his own identifiable portfolio of stocks as well as the fund. Leverage meaning whether a fund can borrow. So in case of CAT 1 and 2, you cannot borrow, whereas CAT 3 is required to borrow, can borrow up to 2x of the NAV or the AUM. And the PMS cannot borrow because there is no pool of funds anyway. So this is a typical structure of AIF, which is very similar to a mutual fund, that you have a fund at the center, which is a trust. And you have a sponsor, you have investors from multiple jurisdictions, it could be offshore or onshore, and you have a trustee. Often we have seen that the trustees are in-house trustees, so it could be a group company which is set up as a trust company, which is separately regulated by SEBI. But otherwise, the fund can also have a third-party trustee, like you can have a ILFS or IDBI as a trustee company, or ICCI trustee company, or a Kotak trustee company for a third-party fund, and you have an investment manager, and then you have multiple investments. So coming to the tax issues, CAT 1 and 2 are largely treated as pass-through, which means that there is no taxation at the fund level, and therefore it is assumed that whatever investors have pooled in are assumed or deemed to have invested in the investee company directly, and therefore any cash flow that is accrued to the fund is assumed to be taxable for the investor, irrespective of the distribution. So this is a major bottleneck that I will highlight a little later, that investor ends up paying tax irrespective of whether the fund distributes to the investors or not. And similarly, the losses are passed on provided the investor has held the investment for 12 months before the investment. And because the tax is at the investor level, not at the fund level, the fund is expected to withhold tax at the rate of 10% for domestic investors or for the treaty for foreign investors at the treaty rates. So this 10% withholding applies to capital gains, dividend, and interest income. And this again is the fund at the end of the year, sort of withhold tax. I mean, it's called deduction of tax it's owed, but it is theoretically it is simply set aside and deposited with the government, so the investor does not get paid anything. As compared to that, in case of AIF 3, the tax happens at the fund level, and investors don't pay any taxes, and therefore the fund pays taxes on all the source of income. And for the purpose of quantifying tax, they look at the investor status. So suppose there are 10 investors, some are individuals, some are companies. The fund will calculate tax with the rate respective for the respective share and will ultimately deposit tax on behalf of all the investors. So though the fund pays taxes, but it is nothing but the aggregate of the tax which would have otherwise been payable at the investor level.
They take individual profile.
They take individual profile, whether you're a resident, corporate, non-corporate, or a non-resident, and accordingly they take the tax at the respective rates. See, generally, if it is in case of Cat 3, the investment is in listed stock. So for listed stock, the tax rate is 10 and 15%, as we all know, for long term and short term. But the surcharge varies depending on the status. So that surcharge varies, therefore the effective tax rate is slightly different for each investor. So they will calculate for each investor, they'll pool it and then they'll deposit the tax. And at the end, then they'll issue some kind of a certificate to the investor saying that this is your share of income and your share of tax which is already been paid. So the investor will simply disclose that in his return, but not pay any taxes. It will show that this is the tax paid by the fund, and now therefore it's not taxable in my hand. So this simply summarizes what the tax we just talked about. That for investors, uh, the tax is payable on capital gain, interest, and dividend at the respective rates. Similarly, for investee companies, there is a investee company, which means that the company whose shares are being held is not required to withhold any tax on dividends or interest. Otherwise, if you were to hold shares or debt directly in a company, then the company obviously deducts tax on dividend as well as interest. But whereas in case of AIFs, there is a specific exemption because the fund does not pay any taxes. So therefore, it receives dividend and interest without any taxation, and that gets distributed subsequently among investors. Then for investment manager, obviously the fees which are collected from the fund, the taxes are paid, and it also pays GST. These are the tax rates on various instruments. So I have categorized in four columns, as you can see. Cat 1 and 2 in the first column, Cat 3, and then PMS, and then last column is mutual funds. And for various categories of investment, whether it's equity or debt, and whether it's long term or short term, these are the tax rates. So largely, as you can see, for listed, it is 10% for long term, 15% for short term, and for other than equity or other than listed debt, it is or rather debt and F&O is 30%. And similarly, for interest and dividends, is 30%. So because that's assumed to be the highest rate when it comes to payment of taxes by the fund. This as we've discussed, I'll skip this. This is what we need to all of us focus on because this is what helps us as investors or us as advisors to investors decide as to what are the key differences. So in case of CAT 1 and 2, capital gain tax rate on capital gain is a normal tax rate because it's assumed to be no pass through. So whatever investor is investing will pay tax the way he would have paid tax when he would have invested directly. So since the fund is assumed to be not existing, you end up paying the tax at the normal rates. But therefore, when you compare that with Cat 3, it is highest rate because of surcharge. Because the fund is not able to identify, or rather, does not depend on the investor's declaration, and therefore, the market practice is that the fund applies surcharge at the highest rate on capital gains. In case of PMS is normal because again, it is identifiable to a particular individual, and therefore, it knows whether it's an individual, resident, non-resident, and therefore, the same thing also for mutual fund. In case of investor, the tax, as I said, is paid by investor in case of Cat 1 and 2. It is paid by the fund in case of Cat 3, and it is paid by the investor for PMS and mutual fund. And the timing of taxation is again crucial that for Cat 1 and 2, investor ends up paying taxes irrespective of receiving any money in the bank account. So the money is lying in the AIF, yet investor pays taxes every year. So this is a serious issue, and a serious issue in the sense that an important aspect which investors should be aware of, that whatever income fund earns, the fund will the investor fund will end up deducting tax. Investor will end up paying tax even if it doesn't get money in his hands. So so both ways. So if there's a profit, investor will show the entire income as taxable. It will claim credit for the tax. It will claim credit for the tax which is paid by deducted by the fund, and it will pay the balance tax. So the fund has deducted 10%, and the investor will pay tax as the remaining tax. If there's a loss, the loss also will get carried forward to the to get sort of passed on to the investor. And yeah, so the investor in the same year will be able to adjust the loss against his other income. So he'll have other income from other sources, so he'll be able to set off. Category 1 and 2 are passed. So the fund will deduct. So let's say the fund has earned 100 and it has 10 investors. So it will tell all the investors that this is your share of income. It will only deduct tax at the rate of 10%. But yeah, 10% is a fixed rate, whatever the nature of income, whether it's capital gain, dividend, or interest. And then the investor will pay full tax. If there is any tax payable more than 10%, depending on the. No, so CAT 1 and 2 they have no option. They have to pay tax. Because at no stage fund will pay the tax. Fund doesn't pay tax. Somebody has to pay it. It's on.
Every quarter we see as a certificate. By default, they have to pay tax. In India also, as well as overseas also, correct?
Yeah.
The recent guideline was there something changes in amendment and all.
Yeah, so CAT 1 and 2 pay on accrual basis. CAT 3, the fund pays the tax. Yeah.
No, actually, the fund is made profit.
Fund has made profit. So
On your way. Fund has done transaction on your behalf. So whatever is the gain on your behalf, you need to pay tax. Yeah. And it's not taxable when you actually redeem that.
Because every quarter they have to give the report. Then you come to know. Realization comes to know.
And this is not an MTA.
no, it's not empty. Luckily, it's not a.
It's not MTA.
Usually it never happens. Generally, usually it comes in HPS, FIS.
Apologies. Can we have this discussion later once this session?
Yeah, we for the sake of this recording. So, so basically, I think Aditya had a very important aspect, question whether the tax is payable on an accrual basis in this is MTM or unrealized gains or only realized gains. The tax is payable only on a realized gains, which means whatever profits the fund books on exit. So therefore, typically in AIF 1 and 2, since they invest in unlisted companies, the trading or churning is not frequent. So they'll buy it, hold it for 3 years, 5 years, 7 years, and therefore only when they exit the tax is payable. But I have seen this happening that income can arise in the first few years as well. So on a year-to-year basis, the fund declares issues some kind of a certificate to all the investors that this is your income. And as he rightly said, they also disclose every quarter because for the fund, for the investor, the taxes will be payable on an advance tax basis. So every quarter they send you your statement of account, and you're supposed to account for that income as well for the purpose of paying taxes during the year itself, and you will get credit for the tax which is deducted by the fund. And as I mentioned in the fourth bullet point, that taxation of income happens even if the NAV is negative, and this happens in the first few years of the fund. That it in case of AIF 1 and 2 is possible because in the first initial year the income may not be significant because the fund may have simply invested. There may be some incidental income where there's some liquidity, surplus cash is invested in some deposits or liquid funds, so there may be some income. But the expenses may be significant because in the initial year, right from year 1, you are paying 2 to 2.5% as management fee on the entire asset size. So this is very common. I have seen this happening in CAT 1 and 2 as well as CAT 3, because the expenses are much higher than the income that the fund generates. So the fund will declare to you that your income is 100, but your share of expenses is 150. So your NAV is minus 50. Yet in case of CAT 1 and 2, you end up paying tax. So this is a serious flaw in the taxation system, and this is what a lot of people are not aware of, and therefore they get surprised to see that in the first year itself, the fund sends you a statement says that this is your share of income. The income is taxable on a gross basis, but expenses are not deductible. So you do your NAV is negative because the management expenses and other operating expenses are quite substantial. So therefore, in real terms, in commercial terms, you not made any profit. You actually incurred loss, but that not loss is not a tax loss; it's an accounting loss, because for tax purposes, the expenses are not deductible. So this is a serious flaw that everybody, the relationship managers or the wealth advisors should be aware of. Uh, and this is an aspect which normally relationship managers don't highlight when an investor is investing. So similarly, in PMS, it's possible that you'll have uh, there's a there is income, but again, PMS expenses are not deductible from that income. And whereas in mutual fund, that doesn't happen, because in mutual fund you have invested, the management fees are charged to the NAV, and therefore your NAV is net of management expenses, management fee expenses, and till investor redeems the mutual fund, it doesn't pay any taxes. So therefore, mutual fund in a way takes care of these issues. Similarly, in terms of compliance by the investor, I've discussed it that in case of AIF 1 and 2, you have to pay taxes on a quarterly basis, and rest of the compliance anyway is similar. So this is the issue I was highlighting, which I have mentioned at the first bullet point, that deduction of management fees, operating expenses, and exit load, these are not deductible for AIF 1 and 2. And the reason is that the tax law says that for calculating capital gains, you have to follow a particular formula. So when all of us as investors, when we buy shares, when we buy a house or any other property, let's say gold, etc., the law says that you simply take sale price, you deduct cost, and you deduct only cost in connection with the transfer of an asset. So when you buy shares on the stock market, you pay brokerage, so that is deductible. When you sell, you pay brokerage or other transaction charges which are a part of the broker's contract, like SEBI charges or transaction fees of the stock exchange or STT. Now, STT, which many of you would have heard, Securities Transaction Tax, is payable on all the transactions that happen on the stock exchange. It's payable at the rate of 0.1 to 0.001%, depending on whether it's a buy, sell, or whether it's a stock or a mutual fund or a debt or otherwise. But STT is not deductible from capital gains. And this is what I have seen many institutional investors also not aware of. So if you are investing in the stock market, the broker at the year end will send you a capital gain statement. Next time you check it carefully whether STT is deducted or not. STT is not deductible. Many of the brokers use a software which may be flawed. So it will show you capital gains which are your real capital gains. Because your real capital gain is because you paid STT. So the STT is also a loss for you, right? Because it's an expenditure. So in real terms, your profit which you think you have earned is as close as to the your accounting profit or the profit which accounting system of the brokers show. So they send you that profit, but the actual accurate calculation of capital gain should show that your buy price is and the sale price are adjusted obviously. So therefore, in AI1, AI3, all expenses, including SCP, are not deductible from capital gain. So therefore, this is one of the reasons that your real profit may be lower, but the capital gain profit for tax purposes is higher, should be higher. And same applies to PMS. But mutual fund takes care of all these issues because your NAV is net of all these expenses. So till you redeem, you don't the profits don't accrue to you for on a realized basis. So therefore, I mean, if I were to advise any advisor, any investor, purely from the tax compliance point of view, I will say that mutual funds sahi hai. So similarly, set off of losses is again an issue for in case of AIF, because AIF you have to hold the investment for 12 months. So similarly, the succession, as I mentioned in the next point, that the successor, legal heir also has to hold the investment for 12 months. Otherwise, you don't get losses. So similarly, in uh, which point you talking about? The first here, first bullet point. So when you give money to 50 lakhs to PMS manager, he charges the management expenses. There is law is not clear whether expenses are deductible. So as I said, the law simply gives you a formula as to how to calculate capital gain. Sale price minus purchase price minus cost in connection with transfer of an asset. So only these three things, two or three things. I mean, this is very academic and in a way, in my view, silly, because the tax laws have not kept pace with the reality. There's no reason for you to have these artificial formulas and artificial restrictions. Ideally, the tax should be on the real income, no? What you are actually earning. Exactly. So PMS, you are paying to the manager, you are paying to the advisor. Suppose you are an advisor, the fee will be payable to you also. These two fees are not deductible from capital gains because the law does not provide for deduction of these fees. So I said ambiguity because there are some people have disputed in the courts. There are some rulings which are in favor, some are against. So I have in my own return I've been consistently claiming expenses, but you never know how and when they will get disputed. So in my view, they are deductible. So so this is my last slide. Any other question on this? So the last few points were in a way related. That that in case of suppose there's a loss, so the loss is possible to set off in case of PMS because the investor is holding that, and the losses are actually in the hands of the accruing in the hands of the investor because there's no separate legal entity. So if somebody is only buying on your behalf, the demat account shows that these are your shares, and therefore the loss also is accrues to you. You get all the notices that company sends you for AGM, etc. Because for the company, you are the registered shareholder as compared to a mutual fund or AI where the fund is a shareholder. So therefore, losses are possible, and then similarly, loss by air is possible. So this again is from these aspects also mutual fund takes care of all these issues.
Just two questions. One is comparison how different we are from the international law in terms of DRS, MS, PMS. Second, if an NRI has invested, so what more permanent?
Yeah. So let me just wrap up this week. So yeah. So I think this was all. There were a couple of other GST issues that are not really important from the investor point of view. So with this, I'll wrap up. And there were a couple of other compliance requirements, but otherwise I've covered mainly the comparison between these three or four rules of investment. So which is let me conclude. Thank you.